Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about what's going on. First of all, the US dollar index has had a pretty significant decline on the day's session, as you guys can go ahead and notice. 10 a.m., 11 a.m., 12 p.m., boom, it just falls. Look at the Dow Jones Industrial Average. 10 a.m., 10 a.m. markets are a little weak. Dollar index is on a winning streak. 11 a.m., 12 p.m., boom, the markets rally. It breaks above its previous day's close. Now, what does this mean? Well, basically, a lot of market participants are still willing, I guess, to buy this market down here. Now the volume is relatively weak, so it's indicative of there's not much institutional participation on the Dow stocks. So that just means market participants are just letting the markets float higher. We're not going to trade in or out. It doesn't really matter. We're just going to hold, and we're not going to do anything with our portfolio of investments, and that's okay. But at the same time, the slow stochastic percent K is breaking below the percent D. It's not really a very accurate indicator, but perhaps we'll see something Thursday, Friday, where some people decide to close some of their Dow 30 stocks and basically close it for somewhat of a profit. But again, when you think of Dow component companies and Dow component stocks, you're thinking of these big blue chip companies that you just hold on to and you don't pay any attention to. And I'm one of those type of guys. I have my low risk long-term investment portfolio, and I do have around 2 Dow component companies inside of it. And therefore, when I think of Dow component, I'm just thinking, it doesn't really matter so much that these pull back by much. I wouldn't really think of closing my position into the weekend, but again, it really depends. Some people are more active about their management, some aren't, so we'll just see. Now, as far as the Dow Jones, it's still above that multi-year trend line. If it can continue to hold on to it for another couple weeks, chances are this market could float back upwards and perhaps even reach 14,000 and reach the multi-year double top. Now, this is a level of legend, I guess you could say, because nobody thought we would ever get there. Not for a long time. But we're getting there, which is a good thing. But it's going to be a while before we do. I mean, we'll have to break this trend line, which we most likely will. And after we do, 14,000 is where we go, guys. I mean, it's as simple as that. Now, if we can't break above this trend line, and eventually we just sink right below it, and we get caught up in earnings dump and everything, and everybody just says, forget it, I'm not going to push this market any further. Death in the skies, people just fall down and everybody loses money, but I don't think that's going to happen. I think, for the most part, unless we have a major pullback this week or next week where earnings dump typically sets in, chances are we're just going to continue going higher, and chances are we're just going to float all the way up to that 14,000 based on this break of these major trend lines inside of this channel, okay, or what I call a pennant pattern. Now, let's move on to the next chart, which is the Euro-US dollar. The Euro-US dollar has been able to break. Now, it has had a clean break from its channel. It's developing another channel, which it might have some trouble breaking above, which I don't think it will. And essentially, here's the idea here. In October, when everything kind of, the dust settled a bit, we had a nice rally. Okay, we went all the way up. 1.32 all the way up to 1.4. Okay, so that's an 1.42. So that's around a 10-point move. Now we're all the way down to 1.27. Chances are, if we were to gain 10 points from 1.27, that's going to be at around 1.37. So that's going to be somewhere around here, around that 200-day moving average. So there's still a lot of upside in the Euro-US dollar market. I definitely wouldn't short the Euro-US dollar right now. I would just let the market rhythm take it where it may and allow it to float higher on macroeconomic moves. We haven't seen Italy. Italian bond yields are continuing to drop for the most part, and because Italian 10-year bonds are continuing to drop That means that people are confident, at least somewhat confident, in the Eurozone as a whole. But you know, I still think 6% is going to be an area where the Italian bond yield might rear its ugly head and decide to rally back up. But you know, for the most part, the yields are dropping. The Euro-US dollar is going higher. Those are great things for us. And essentially, until something bad happens coming out of the Eurozone, chances are the Euro-US dollar will be able to continue this rally. And if it continues this rally, it's probably going to go up another, you know, six more points, all the way up to that 1.37 area. Because we take this area, and you know, we measure it, and we're thinking, maybe it'll go up by that much at the very least. I think so. This is just typical market behavior. Now, moving on, I want to talk about the next chart, which is gold. Gold has had a tremendous move to the upside. In fact, it breaks above its multi-year channel. Now, a break above the multi-year channel is very good. We're just going to have to wait a couple more days and see if it's just able to stay above. It doesn't, you know, just tanks and falls right below. You know, we really want to be patient here. But, you know, now is a great time to buy gold. The main reason is because it's above that 200-day moving average, finally, and it's broken the multi-year channel. Because both of those criteria have been met, the gold market is a very, very great place to be at this point and time. Now I want to just go ahead and show you something on a day's session. Boom, you know, gold, you know, at 12 p.m. gold just has this humongous rally. It just, you know, just rips all of these bears apart. Okay. Now we look at the U.S. dollar index, and it falls at around 11 a.m. Right? It just tanks. And so 11 a.m. and gold at 11 a.m. both correspondingly opposite to one another. Now this is just, you know, this is just what the markets work off of. So you really want to keep a close eye on the dollar index, but more importantly, the currency pairs that trade against the U.S. dollar. For as long as the U.S. dollar continues its weaker move, and I think it will, mainly because the Euro-US dollar is on a really, really strong uptrend. Italian bond yields are doing all right. If this continues, chances are it all goes back to the Dow Jones being able to break above this area, and all of a sudden, when markets and equities, equities, securities, they all rally. You know, commodities are doing good. It creates this whole entire wealth effect, and fortunately, it didn't require the Federal Reserve to use quantitative easing to accomplish any of this. But that's what happens. You know, the dollar falls. Dow Jones Industrial Average goes up. Dow Jones Industrial Average breaks this area, and the U.S. dollar index continues to fall. Your U.S. dollar is able to continue to rally. Gold and silver responds with their own cheer rally, and they start going up like crazy. A lot of people are buying gold and silver for the sake of appreciation. We buy stocks for the sake of appreciation. And lo and behold, Apple just comes along around the corner, and they report exceptional earnings. You know, they double their profits by around twice of what they did over the previous year. Again, let's think of the numbers real quick. Apple makes more profit than Walmart does, okay? More profit than Walmart, okay? Apple, the company Apple, is worth more than Greece's gross domestic product, and perhaps half of Africa as well. So that kind of gives you a glimpse into just how successful Apple is right now. And do I think there are going to be more companies on the horizon that can become as successful as Apple? Absolutely. You know, technology is a very interesting space because there's always room for more players. There's always room for more growth. You know, and technology is kind of an oxymoron because what technology really is just it impacts every industry. But I guess we call the tech sector the latest technology boom. Okay, it used to be about automobiles, and then all of a sudden we go into, you know, biotechnology, big pharma. And then we go into internet. We go into radios. We're talking about so many different technologies. But again, you know, technology companies are by far the most exciting of companies, and we see that on a day-to-day basis. Now, as far as Research in Motion had this nice little sympathy play. It wasn't a very strong stock, okay, and it still isn't. I mean, I'd much rather own Apple, but not that I do. But I mean, if between Apple and Research in Motion, you know, I would choose, you know, Apple all the way. But the thing is that Apple reported such great results. We think or market participants are thinking that, hey, maybe Research in Motion can do just as well of a job. Maybe Research in Motion is a great stock or something like that. But again, that's just a sympathy play, and that's just because Apple was able to report such phenomenal results. Research in Motion is, people are thinking, well, maybe Research in Motion will do the same thing. But again, Research in Motion and Apple are two very different companies. Between a BlackBerry and an Apple iPhone, it's easily an Apple iPhone. So no question there. Research in Motion is a pretty, it's not a stock that you would own because you think that they're having explosive growth, they're a wonderful company, etc., etc., etc. It's just because the stock is cheap, okay? It's a cheap stock. I was thinking that it could perhaps go lower. I wasn't even able to make an entry because, Research in Motion was just floating and floating and floating higher, and I was just like, man, when is this ever going to pull back? And I was looking at Apple, and I was just like, oh, okay, that's never going to pull back because, as far as I'm concerned, Apple has done such a great job. People are thinking Research in Motion might do as great of a job as well. And right now, Research in Motion is trading at around a 3.8 price to earnings ratio. So it's a very, very cheap technology company. Their earnings are growing at the rate of, I guess, Microsoft. So they're kind of dead in the water in terms of significant growth. And people are even anticipating erosion in their performance in quarter 4, 2012, or basically quarter 3, quarter 4, 2011, versus what they did in quarter 4, 2010. So again, we'll just see. We'll just see whether or not this company is able to grow any of its earnings, or at the very least manage their operations effectively enough, or if they're just a loser. We'll see. We'll see if it's a worthy value play. Take care, folks. I'll see you later.